You've talked about this quite a bit over the last several weeks and months, Luke, but yeah, I think you really are a holistic capital solutions provider now to the private equity and the private markets. And I think the Stellus acquisition brings in another kind of added capability on the credit side. And so you're an LP in a lot of these private equity funds. You can provide the debt capital and the leverage for those deals, NAV lending, GP stakes, et cetera, et cetera, et cetera. So was this kind of the last kind of added capability or enhancement to kind of fully offer that kind of solution to these GPs? Like, I just want to think through or walk through how you're thinking about this and that dynamic, and then kind of the evolution of what you can do ultimately with sponsors longer term.
And this is part of the strategic vision that we have and we're trying to bring to bear. Ultimately, we want to be the category killer solution provider in the middle and lower middle market. That is the aspiration. And so I wouldn't say that this is the last, but I would say it's an important component of what we're focused on. And so when we started this journey a couple of years ago, now 2.5 years ago, we talked about at our investor day, there were 3 areas of strategic import based on LP feedback, based on looking at where the opportunity set was, that we thought would be incredibly additive to the Ridgepost Capital platform. The first was international strategies and as I like to call them, international analogs of our US businesses. And obviously the Qualitas deal that we did last year was a big component of that. They're essentially the international analog for RCP advisors. And we still think there's a lot of white space internationally across Western Europe, across Asia. The second was we really wanted to go deeper because of our centrality in this GP sponsor ecosystem. We wanted to go deeper and leverage those relationships in private credit. And so we have some great private credit businesses, but we also had some real gaps in our skill set and capability set. Direct lending was at the very top of that list. I also think about things like asset-based lending. I think about things like distressed and opportunistic credit. And then the third area we identified is the real asset opportunity, whether that's real estate or infrastructure. But I think the reason we're so excited about the Stellus transaction is because when you think about all those opportunity sets, it was so obvious that there was a big opportunity in the middle market in direct lending. And so we had the opportunity to really partner with the world-class platform in doing that. And we think the combination of our network of relationships, our skill set, and their obviously incredible investing acumen, when you put that together, that's a winning combination.
I'd say a great environment to continue to lend. We see a lot of opportunity for private credit generally, but especially in our market, the lower middle market. Interestingly, the best data we have would tell you that there's roughly 10 times the amount of dry powder in lower middle market private equity firms as there is in lower middle market private credit. So we're very busy, continue busy. In fact, we've been busy for 10 plus years, so continue to be busy. And we focus certainly on underwriting, which we'll maybe talk about a little bit later, but very important in terms of our underwriting, have a long track record of doing that. But optimistic about where we are. A lot of noise, as you say, in the system, but I think it's starting to settle out as it should.
I think it'd be helpful just to walk through your underwriting process a little bit and how you can leverage the different cycles you've seen in the past and all that data and the trends there to make better, more informed decisions moving forward.
Sure. So in terms of underwriting, again, always been a core part of our business. Maybe talk about it a little bit in different examples. So when we look at a new company, we've always looked at it, what if we have a recession in the next 18 to 24 months? And back test, if you will, if the company existed for recessions. If it didn't exist, did the sector exist for that last recession or two? And if the sector didn't exist, which is common today, we look for a proxy or an analog to look at it. So we're looking, underwriting is, can this company survive a recession, first of all? I'd say the second thing, very selective in our execution. So roughly 3% of what we look at over 20 years, if you will, we close. So highly selective. How are we able to do this? Tremendous deal flow, opportunities that come to us through our managing directors. By that'll be even more when we're part of Ridgepost, I would say. So it may go down to 1.5% in terms of selectivity, but hopefully all those will be hits and winners. I'd say the other thing is in the lower middle market, we really benefit from something that might be different in the upper market in that the capital structures are quite strong. So typically you're getting 50% or more equity checks below us at close. We have financial covenants in all of our deals. And as an example, in our most recent fund, Stellus Credit Fund 4, we have 41 new investments. The average equity check below us is over 60% of the capital, and the average EBITDA is about 3.5 times EBITDA level. So very strongly structured companies. In terms of the macro environment today, certainly there's a lot of things going on, including the war in Iran, which has elevated certain things like commodity prices, certainly in oil, but very limited, if any, impact on our portfolio. But anyways, solid position. Whether we can make mistakes or we work hard on them, but they're very rare.
Yeah.
And all of our partners have restructuring experience, so it informs both our investing as well how we handle problems.